Hey, welcome to The Explainer. Today we are diving into a topic that's at the very heart of pretty much every investment decision, valuation. How do you actually figure out what a company, or an asset, or even just an idea is really worth? Well, stick around, because by the end of this, you're going to have the framework that the pros use to find that answer. Let's get right into it.
In this quote right here, it's the perfect place for us to start. It tells you straight up that valuation isn't some simple push-a-button process. Not at all. It takes the hard-nosed precision of science for all the analysis, but it also, and this is crucial, demands the judgment, the creativity, the art, really, to interpret what the numbers are telling you and navigate all the unknowns.
So why a craft? Because a great valuation has to bridge two different worlds. On one hand, you need a believable story about the company's future. Where's it headed? What's the big plan? But on the other hand, you need the hard numbers, the financial models that are going to stress test that story to see if it even holds water. Because let's be honest, a story without numbers, that's just a fairy tale.
Okay, but before we even think about building a valuation, we got to understand the things that are actively working against us. I like to think of it as the valuation Bermuda Triangle. A spooky place where even the most solid analysis can just disappear without a trace.
So these are the three corners of that triangle. First up is bias. That's when analysts feel pressure from a client, or, let's be real, even from their own wishful thinking to get to a specific number. Then there's uncertainty. The future is, well, the future. It's fundamentally unpredictable. And finally, you have complexity. Modern companies are these incredibly intricate machines that are just really hard to model accurately.
It sounds like a total minefield, right? So with all these traps just waiting for you, how in the world do analysts find their way through it all and land on a valuation that's actually credible?
Well, they do it with a toolkit. A toolkit built on three fundamental approaches, or pillars as we'll call them. First, there's discounted cash flow, or DCF, which is all about finding a company's true intrinsic value. Second, you've got relative valuation, which is more about pricing it against its peers. And third, there's option pricing, a way to put a value on something really abstract, flexibility. Let's break each one of these down.
All right, let's dive into that first pillar, the hunt for a company's deep, fundamental, you could say intrinsic value.
This brings us into the world of discounted cash flow, or DCF. Now, the core idea here is actually pretty simple when you think about it. The value of a business is just all the cash it's expected to make for the rest of its life. But here's the kicker. That cash in the future has to be discounted, right? Because a dollar you're promised next year just isn't worth the same as a dollar that's in your hand today.
Now, what makes DCF so powerful is that it forces you to tune out all the daily market chatter and noise. It's a pure, bottom-up approach that asks one single, focused question. Based only on its raw ability to generate cash, what is this thing fundamentally worth?
Now, our second pillar takes the complete opposite view. If DCF was all about looking inward at the company itself, well, relative pricing is all about looking outward at what everybody else is doing.
Yeah, these two mindsets are worlds apart. Intrinsic value asks, what is this thing actually worth on its own merits? But relative pricing asks a totally different question. Hey, what are similar things selling for? Think about it like pricing a house. You could analyze the foundation, the square footage, the materials. That's the intrinsic approach. Or you could just check the sale price of the nearly identical house that just sold next door. That's relative pricing.
So how do you actually do this comparison in the real world? Well, analysts use these things called multiples to kind of standardize the prices. The most famous one, the one you've probably heard of, is the price to earnings, or PE ratio. It just connects a company's stock price to its profits. Using multiples like these lets you do a really quick apples-to-apples comparison across a whole industry.
All right, our third and final pillar. This one tackles something that the first two methods can really struggle with: putting a price tag on future choices, on strategic flexibility.
This right here is the big question this pillar tries to answer. Think about it. What's the value of pure potential? What's the value of having the right to do something in the future but not being forced to? How do you even begin to calculate that?
This is where a fascinating idea called real options valuation comes into play. It's built specifically to value assets that have this huge but really uncertain potential. For instance, a patent for a new drug.
It might be losing money today in R&D, but the option to commercialize it if it turns out to be a blockbuster, that option is incredibly valuable. The same logic works for undeveloped land with oil under it, or even something as simple as the option to pull the plug on a failing project to cut your losses.
Okay, so we've walked through the 3 pillars. Now let's tie it all together, because this leads us to maybe the single most important takeaway in all of investing. The one big distinction that can give an investor a real edge.
First, let's be absolutely crystal clear about what we mean by value. This is what an asset is worth based on its fundamentals, its cash flows, its growth prospects, its risks. It's the number you get after you do all your homework, all your analysis. Think of it as what the asset should be worth.
Price, on the other hand, well, price is just the number blinking on the screen. It's what something is trading for right this second. And price is messy. It's driven by supply and demand, by the mood of the market, by news headlines, by fear, by greed. As the old saying goes, price is what you pay, value is what you get.
And here it is. This is the whole game. The entire mission for an investor is to find a gap between those two things. You do the hard work, you run the numbers, you estimate a company's intrinsic value. Then you look at the market price. And if that price is way below the value you came up with, well, that's it. You've just found the potential opportunity.
And that leaves us with one last really powerful question for you to take with you. The next time you see a stock ticker flash on a screen, just pause for a second and ask yourself, am I looking at the price or am I looking at the value? Because just knowing there's a difference, that's the first real step to mastering this craft. Thanks for joining me on The Explainer.